Hello dear students, today I am going to discuss with you a very important topic of chapter 9 of class 12th business studies. The name of the chapter is financial management and the topic which I am going to discuss with you is financing decision, and I am discussing this topic briefly. I would advise that after watching this video, do read NCERT very carefully. This video is basically an attempt to make you understand what financing decision is. So you are aware that in this chapter of financial management, there are three types of decisions, financial decisions. First one is investment decision, where you decide where to invest. Second is financing decision, that is where to get funds from. And the third decision is how would you distribute your profit, how much profit you are going to retain and how much profit you are going to distribute as dividend. So in this particular video, we are going to discuss financing decision. So coming to first the meaning of financing decisions. These are the decisions relating to quantum of finance or the composition of funds from various long-term sources. So if business need funds from long-term sources, what are the various sources which you can use is, the two long-term sources are, first one is owners funds or equity, and it consists of equity share capital, preference share capital, and reserves and surplus, or you can say retained earning. Second source is borrowed funds. Borrowed funds, the another name is debt, and debt can be in the form of loans. It can be there in forms of debentures, public deposit, etc. So basically financing decisions decide, so what will be the composition of the funds you are getting from long-term sources, that is how much will be the equity and how much will be the debt. So before we move further, let us first understand that how debt and equity are different on the basis of cost and risk. So let us see the first basis, cost. So if you compare debt and equity on the basis of cost, you can see debt is cheaper, whereas equity is costly for company. So here I am talking from the point of view of company and not from the point of view of investor. For company, debt is cheaper and equity is costly. And the reason for this is, let us first see about equity. Why equity is costly? So equity is costly because it involves high flotation cost. Now what do you mean by flotation cost? It is a cost of issuing securities in the market or floating shares in the market. So there are a lot of flotation cost involved, like cost of advertising, printing prospectus, underwriting fee, legal fee, registration fee. So if you are issuing equity in the market or shares in the market, the flotation cost is very high. But if you compare it with debt, debt involves less flotation cost. So this is the first reason why equity is costly for the company, whereas debt is cheaper. Second reason is on equity, there is no tax saving. So when company issue equity shares, it does not save the tax of the company, and the reason is dividends are paid out of after tax profit. Means first you pay tax and then you pay dividend. So dividend does not save the tax of the company, whereas if you see in debt, debt saves the tax. And the main reason why it saves the tax is because the interest which is paid on debt is a tax deductible expense, which means that when you pay tax, interest is paid first and then tax is paid. So it saves the tax of the company. So if company is earning profits, first they pay interest and then they pay tax. So this interest is paid before tax, and in this way it saves the tax of the company. And we are going to do this practical question where I'm going to show you that how by paying of interest the tax of company is saved. And the topic is trading on equity, which we are going to do little later. But please remember, the interest paid on debt saves the tax of the company, whereas the dividend paid on equity does not save tax. Why? Because dividend is paid after paying tax. So you have paid tax and now you are going to pay a dividend out of the profits which are left after tax. Now coming to the second basis, that is risk. So if you compare debt and equity on the basis of risk, you can see debt is highly risky, whereas equity is considered as riskless for company. And what is the reason? When you take debt, there are two obligations. One is payment of interest, and on maturity you need to return the principal amount. So these are two obligations which are there if you take debt, and these are obligatory for the business. Even if business is incurring losses, you need to pay the interest and return the principal amount. There is no excuse. So taking of debt therefore is very risky, and the name of this risk is financial risk. So what is financial risk? The risk that company will not be in a position to pay interest or the principal amount back. So this is a highly risky situation for the company. The people who have given you loan, they may take the assets which you have given as a security, and it may lead to closure of your business if you are not able to pay your debt interest and the principal amount back. So this risk is called as financial risk. So debt is highly risky for company. Whereas if you come to equity, payment of dividend is not compulsory. Payment of dividend is optional, and the principal amount of equity is to be returned only when the company is winding up the business. So there is no burden that they have to return the money. So there is no compulsion for you to pay dividend, and as far as principal amount is considered, it is to be returned only when you are winding up your business. So equity is considered as riskless, where debt is considered as highly risky for the company. Now let us discuss the factors affecting financing decision. And I have just told you what is financing decision. We have to decide that out of long-term sources, how much will be our debt and how much will be our equity. Debt is borrowed fund, whereas equity is owner's fund. So what are the factors that a finance manager has to keep in mind while taking a financing decision? So the first factor is cost. And I have just discussed above that out of debt and equity, which is costly? Equity is costly for the company, whereas debt is cheaper. Therefore, a finance manager will normally opt for a source which is cheaper. So keeping other factors constant, the finance manager will choose debt because debt is cheaper as compared to equity. So let us see the second factor, that is risk. This also I have discussed above when I was comparing debt and equity. We know that debt is very risky. It has a higher financial risk, whereas equity is considered as riskless. So finance manager has to see that which particular source of finance he has to choose, keeping in mind the risk involved. So if he wants to take higher risk, he will prefer debt, otherwise equity. So the next factor is level of fixed operating cost. Now, what do you mean by fixed operating cost is the cost which remains same or fixed irrespective whether you're producing more or less. Example, rent, salaries. So these are called as fixed operating cost. So you have to see how much is your fixed operating cost. Is it high or is it low? So fixed operating cost high or fixed operating cost low. Then you have to compare. Accordingly, you will take a decision about your financial cost. Now, what do you mean by financial cost is the cost of issuing debt. So you know that when you take debt, you need to pay interest. So that cost is called as financial cost. So please see, if your fixed operating cost is high, what you do is you try to lower down your financial cost. So if you have to lower down your financial cost, means you are not going to take something which is going to increase the financial cost or interest. So in this case, the firm is going to go for equity. Whereas if your fixed operating cost is low, you can go for higher financial cost. So means you can go for giving of more interest. So in this case, you can go for debt. So basically here you have to see your fixed operating cost and accordingly decide whether your financial cost will be less or more. So if you want to increase your financial cost, debt. If you want to decrease your financial cost or don't increase your financial cost, go for equity. Next is control. So you must be aware that who are the people who actually control the company, or who are the people who become the board of directors of the company. So they are basically equity shareholders. They are the real owners of the company. They become board of director. They have the voting rights. So if equity shareholders, they want that their control should not be diluted, in that case they should go for debt. But if they have no problem in losing their control, then they can go for equity. Now I want to give you an example here. Suppose you are a board of director of the company and you have 1000 shares out of total 10,000 shares. So here your control is, do you agree it is 10%? If company issues more share, for example, if company issues more 10,000 shares and you are not buying new shares, the denominator will become 20,000. Can you see now your control is decreased? Earlier you had 10% control, but with issuing of more equity shares, your control is diluted. So if you don't want your control to be diluted, it is better to go for debt. Otherwise, you can go for equity. And one more thing, sometimes company may face a takeover threat. Now, what do you mean by takeover threat is when somebody, some company buys 51% or more shares of your company, that company can take over your company. So if you feel that if somebody is buying the shares in the market and you are facing a takeover threat, they may take over your company in future. So in that case, it is better not to issue equity shares. In that case, you should go for issuing of debt. Because when you're issuing debt in the market, competing company who is planning to take over your company, even if they buy debt, they will not be able to take over your company. Okay. Next is state of capital market. Now, capital market is your share market or securities market. So sometimes there is a boom period in the market and sometimes there is depression. Now, what I mean by boom period is when the share prices are rising. So when the share prices are rising, we say it is a boom period. And a depression period is a period when the share prices are going down or they are declining. So you have to see as a finance manager what is the condition of capital market. During boom period, people will be ready to buy the shares. They are in mood to buy shares. So you should offer equity at that time. But during depression period, when share prices are declining, people don't want to invest the money in equity. They prefer to invest their money in something which is more safe. So in that case, you should issue debt in the market. Now let us revise what we have done till now. So we have done what is financing decision, and we have also done how is debt and equity different on the basis of cost and risk. So we have done a table where we compared debt and equity on the basis of cost and risk, and then we have also done factors affecting financing decision. So I hope these topics are clear to you. Let us try a few questions based on this. Let us see the first question. A decision is taken to raise money for long-term capital needs of business from certain sources. What is this decision called as? So we have done this. This is financing decision, where we decide that which sources we are going to use. Second is what is considered cheaper source of finance. So if you compare debt and equity, which out of this is cheapest? So we know that debt is cheaper as compared to equity. Equity is costly. Third, what is cost of raising funds called as? So when you are raising funds from the market, when you are issuing securities or debentures in the market, what is this cost of raising funds called as? So the answer is flotation cost. Okay. Now coming to this fourth question. If a company is unable to meet its fixed financial charges like payment of interest and repayment of principal amount of debt, what is this risk called as? So this risk is called as financial risk, and this happens when you take debt. Let us see the fifth question now. So first of all, always read from below. What we have to do in this question: state the function performed or the decision taken by the company for arranging the funds through debt and equity. So what is that decision called as? Although we can get the answer from this line itself, but let us read the case study also. Bharat Steel Limited, an Indian company producing 50 million tons of steel annually and generating revenue of $38 billion US, has recently acquired the world's second largest steel producing company, German Steels. After this acquisition, Bharat Steel Limited will become world's largest steel producer. For this acquisition, Bharat Steel Limited had to arrange about rupees 50,000 crore through debt and equity. So when you are arranging money through debt and equity, what is this decision called as? This decision is called as financing decision. Now let us discuss these factors. So we have done factors affecting financing decision. So there are total 7 factors which we did. So let us discuss them very briefly. So if you go for cost, you know that debt is cheaper, whereas equity is costly. So obviously finance manager will choose something which is cheaper. So debt will be preferred. Okay. Next is when you compare risk. If you compare debt and equity, we know that debt is risky, very risky, whereas equity is riskless. So it is up to finance manager. If finance manager wants to take more risk, debt, less risk, equity. Then coming to flotation cost. So we know that flotation cost of debt is low, whereas flotation cost of equity is high. So a finance manager will opt for a source which will involve less flotation cost. So it depends. If business has enough money to bear the flotation cost, equity, otherwise they have to go for debt. Next is cash flow position of the business. So you may be having a good cash flow position or a bad cash flow position. Please remember, when the cash flow position is bad, don't go for debt. It is better to go for equity, but if you feel your cash flow position is good, you can go for debt so that you can pay the timely interest and you can return the principal amount. Next is fixed operating cost. Your fixed operating cost may be high, your fixed operating cost may be low, and accordingly, if your fixed operating cost is high, you try to lower down your finance cost. So in this case, you will go for equity. But if your fixed operating cost is low, you can afford to have high finance cost, so you can go for debt. Next is control. We know that if we issue equity shares, control is diluted. But if we issue debt, no dilution in control. So business has to see whether they are ready for their dilution of control or not. And here I have also mentioned, if you are facing takeover threat, it is better you should go for debt. Next, coming to state of capital market. Your capital market may be having a boom period or depression period. So when the boom period is there, we know that share prices increase, and during depression, share prices are declining. So during boom period, it is better to go for equity, whereas during depression period, don't offer equity, nobody will buy. It is better to go for debt. So if you can make a mind map or a flow chart like this, these factors will be easy for you to understand and explain in exam. So that's it for part 1 of financing decision. I hope it is clear to all of you. I wish you all a happy learning. Bye.